Welcome back to another financial brief, this one under 6. Today, let's talk about your mortgage. Should I put extra money towards my mortgage? It's a question we get in every financial planning conversation, and I get it. You're paying interest on your mortgage. The sooner you get that paid off, the less interest you pay. Once it's paid off, you could then take what was your mortgage payment, put that money into an investment account, and accelerate your savings. It's a sound strategy, but in this scenario, I think numbers speak louder than words. So I created a calculator. This calculator will show you when it may make sense to put extra money towards your mortgage and when you may want to consider doing otherwise. This first page is a simple loan calculator. I can put in any loan amount, any interest rate, and the number of years for the loan, and it will tell me what my payment would be. So let's say I have a $400,000 loan. That's at a 3% interest rate and is a 30-year mortgage. It's telling me my payment would be $1,686 to cover principal and interest. And to confirm our math, we scroll down here to the bottom of the sheet. We do see that at month 360, we do have that loan paid off in full. This calculator only calculates principal and interest because we don't really care about escrow. Property taxes and insurance is still going to be a cost to you whether the house is paid off or not. I did add a total interest box here so I can see immediately the impact of each loan. In this particular scenario, it's going to cost me $207,000 in interest just to have this loan. I also added an extra payment box so I could run different scenarios. Let's say I wanted to pay an extra $500 towards this loan. I see that the month paid off goes from 360 to 245, so just a little over 20 years. My total interest also dropped from $207,000 down to $135,000. So if you have an extra $500 in cash you could put towards the mortgage each month, that could make sense, especially if the alternative is saving that money in cash or spending it. You're going to have the mortgage paid off almost 10 years sooner and save yourself over $70,000 in interest. With the house paid off, we can take what was our interest and principal payment, add on top of that the extra payment, and put that combined amount into an investment account for it to grow for us. I run that scenario on page 2 of this calculator. We have an initial deposit of $21.86, followed by a monthly contribution of the same amount. I calculate that at an 8% annualized rate of return, compounding monthly. We scroll down to year 9.5, or the completion of what would have been our 30-year term, and we see that not only is the house paid off, but we have just under $400,000 in our investment account. So not a bad spot to be in. We have a house that's paid off. We have almost $400,000 in cash to help us in retirement. But would we have been better off just putting that extra $500 into an investment account from the get-go? I ran that scenario on page 3 of the calculator. I have an initial deposit of $500, followed by a monthly contribution of the same amount. I'm running the same annualized rate of return at 8% compounded monthly. Now, instead of scrolling all the way to the bottom, I did create a quick view page on page 4. Up top, I have the loan details, so $400,000 loan, 30 years at a 3% interest rate. I then have here the scenario where we pay the house off early and then invest the payment. I actually figured out the exact month where the house is paid off, subtract that from 360 to figure out how many months I can have that money compounding in an investment account. Now I only have this picture here because I like the element of surprise. So once we delete this, we'll see that if we just kept the original length of the loan and invested that extra $500 from the very beginning, at the end of 30 years, we would have $745,000 in our investment account. When we go to the bottom of our calculator here on page 3, just to confirm, we see that that is the case. Keep in mind that when we look at the scenarios this way, the amount of money that we pay in interest is irrelevant. At the end of 30 years, in both of these scenarios, you have a home that's paid off in full. So the only difference is how much money do you have in your investment account? Well, in the second scenario, you have almost twice as much. The reason I set up this quick view page is so I could quickly see how changes in interest rates and duration impact the strategy we use. So right now we have the difference of $364,000, but if I was to change it to 5% instead of 3%, we can see that the difference is only $249,000. Still a substantial amount. We'd probably still side with putting that extra money into an investment account. But let's say the loan was only 15 years instead of 30. Well, now we see that the difference is only $29,000. This is where you can start going, I feel better having the loan paid off, and that feeling is worth $30,000 for me. If you're having these conversations, that means you have extra money every month. And that's a good spot to be. If you don't have access to an investment account, paying off the mortgage early is not a bad strategy. You will want to work on getting access to an investment account so that by the time the mortgage is paid off, you can take what was your mortgage payment and get that money working for you. Or if you would like to get money invested today, we can open up an account and manage those investments for you. For more information, click the link below and schedule an appointment.